Hello, I hope you're doing well. My name is Jacqueline Vino from Golosso Learning Solutions, and welcome to this Nano recording. Today, we are going to discuss ASU 2024-03, also known as DICE. I do want to say right off the bat that this is a huge standard. It is actually 125 pages in total. All we can really do in this brief Nano recording is just hit some of the highlights and summarize some of the main changes. However, if this standard does impact you or your clients, I would highly recommend investing in a deep dive to get more information. We've got a lot of things to cover during this recording, and with that being said, let's go ahead and get started. So ASU 2024-03's formal name is Income Statement, Reporting Comprehensive Income, Expense Disaggregation Disclosures, Subtopic 22040, Disaggregation of Income Statement Expenses. But we will call it DICE for short, because that is definitely a mouthful. And this was issued by the FASB in November of 2024. So why did the FASB decide to issue this standard? Well, it was actually a project that was requested by investors on the 2021 FASB's Invitation to Comment agenda consultation. So no one else is particularly excited about this. This is primarily just the investors category. This is something that was really requested by those individuals that are just super interested in very disaggregated information and someone that really wants to know all of the details. Now, what investors really took issue with was SG&A in particular. They thought that it was a little too generic, a little too combined together, and they really just wanted more information and more details. So what is the scope of this standard? This is only going to apply to public business entities. You guys are the lucky ones in this case. This does not apply to private companies, nonprofit organizations, and most employee benefit plans that are within the scopes of topics 960, 962, and 965. So the PCC and NAC certainly did not have an appetite for this, nor did the employee benefit plan side of the house. So just the public business entities. Now, we'll get into the nitty-gritty of this in just a minute, but first, what are some of the main takeaways from this standard? Now, first and foremost, it does provide new expense disclosures. They are going to be more specific about taking these expenses and, no surprise here, disaggregating them as the name intends, and also taking amounts that are already required for disclosure and reformatting them, so giving them some new consideration. We're also going to talk about some qualitative descriptions of amounts that are not required to be disaggregated, but to help understand what is in those ones that are aggregated together. And one of the main complaints of investors disclose the total amount of selling expenses and the definition of what is a selling expense. So what is a selling expense to one company might look a little different compared to selling expenses of a different company. So this is something that they really wanted to standardize a bit more and to make sure that everybody is disclosing this. So where do we see some of the big changes here? Well, we must present specific expense captions on the face of the income statement. And so going forward, we are going to be required to present these specific captions on the face of the statement, and those are going to be mandated captions, right? We have to have these. And in addition, we must disaggregate and describe what makes up the remaining expenses as well. So when we get into this, it's not only going to impact just presentation on the face of the income statement, but it's also going to impact disclosures and the notes to the financial statements as well. And in addition, while we are adding a bunch of new disclosures, we're also not going to be removing or taking away any of the current expense disclosure requirements either, but it may impact where that information appears for consistency purposes. So let's talk about a very key term here. This is something that's very important to understand the DICE standard as a whole, and that is what is considered to be a relevant expense caption. Now, this is something that's used over and over and over again in the standard. If you do, Control F in the 125 pages, it shows up hundreds of times. And a relevant expense caption is an expense captions presented on the face of the income statement in continuing operations only. So we are not talking about anything below continued operations that contain any of the expenses that are required for disaggregated disclosure. So what would be some of those items that are required, that are the required expense captions? This would be things like cost of product sold. That would be if you have a product-based business. We also have cost of services for anyone that does service-based type businesses. Selling, general, and administrative expenses, again, one of the primary complaints from investors, and depreciation and amortization. So these are the types of expense captions that we are going to see on the face for presentation on the income statement. And then these relevant expense captions that we just talked about are required to be disaggregated, right? So think disclosed into certain categories. Now, what are these categories? We have purchases of inventory, intangible asset amortization, we have employee compensation, depreciation, and DD&A. So for those of you that are unfamiliar with what that is depreciation, depletion, and amortization for oil and gas producing services. And so when we think about this and we compare that to the previous definition, what does all of this mean? So these right here, what you see on your screen, these are the types of things that can go into cost of sales, right? You can have employee compensation be part of your cost of sales. You can also have the purchase of inventory be part of your cost of sales, and so forth. So basically, within your cost of sales required expense caption, what is coming from each of these 5 categories here? So we need to take from each of these disaggregated elements to meet the presentation requirements. Now, there are a few exceptions that we have for some obvious reasons here. An entity is not going to be required to further disaggregate costs to capitalize as an asset, even if those costs include categories required for disaggregation. So for example, if amortization costs to fulfill a contract with a customer, so think about topic 606 for revenue recognition, if that included things like employee compensation, we would not need to disclose those in the required disaggregated categories. And when we think about topic 606, we have the costs to obtain or fulfill a contract, and that gets parked on the balance sheet. So even if they are going to be in one of those line items, you don't need to actually disclose that in the required disaggregation categories. However, we do have a slight exception to that rule with things like inventory. Inventory needs to be disclosed under that cost incurred method. This asset is a little bit different compared to, other types of assets because they are generally part of your cost of sales. And as a general rule of thumb, though, outside of inventory, your asset-related expenses don't need to be further disaggregated. Now, there's also an exception for liability-related expenses. So you are not going to need to disaggregate expense amounts into categories if you meet specified criteria. So, for example, any expenses relating to obligations that will be settled in the future, and there is uncertainty about the timing of that settlement. So think about things like asset retirement obligations or provisions for losses on contracts, right? Think about the CECL standard. That would be an instance of this. Also, the expense related to an obligation that is based on an estimate of future expenditure. So if we're subject to some estimation uncertainty. And last but certainly not least, the expense is not entirely made up of one of the required expense categories. So if it's not clearly sitting in one space, for example, employee compensation, then we are not going to have to disaggregate out the liability related expenses. They also do provide us with 2 practical expedients. So the first one is with the purchases of inventory. So when substantially all of an entity's income statement expense captions comprises of the purchase of inventory specifically, you actually don't need to apply this guidance. However, though, because you're using a practical expedient, you're still going to need to disclose that you are using a practical expedient in your financial statements. We also have another practical expedient for employee compensation. So the one that applies here is an entity that presents an expense caption for salaries and employee benefits on the face of its income statement to comply with the requirements of SEC Regulation SX. You may use those amounts that are classified to comply with Regulation SX, right? So the caption would be salaries and employee benefits instead of employee compensation, right? So trying to meet the requirements there. And another thing that we also need to consider is expense reimbursements, if this does apply to either you or the entities that you work for. So if you do have expense reimbursements and these types of things, we're either going to need to separately disclose the amounts of the expense reimbursement, or we're going to have to disclose the amounts of the expense categories net of any reimbursement effects, right? So we do have some criteria there. And then last but certainly not least, we also have some additional requirements with defining what actually constitutes a selling expense. So for interim and annual reporting periods, we are going to be required to determine what actually constitutes a selling expense and disclose the total selling expenses recognized, once again, in continuing operations. And then for annual periods, we are going to be required to disclose how your entity defines the term selling expenses. And again, remember, investors wanted that to be able to compare that across different organizations. Additionally, if changes occur to the definition prior to the interim period, we also need to disclose the definition in the interim period as well. So when is the effective date for this standard? Again, this is only for public companies, and this is for annual reporting periods beginning after December 15th of 2026. And this effective date was actually a little bit confusing when they first issued it. The problem, as you can see right here, is there's an issue with how they wrote the interim reporting periods item, so much so that the first standard they actually issued in 2025, so ASU 2025-01, was actually to clarify the effective date for this further, but for annual reporting periods beginning after December 15th of 2026 is when this has to be adopted. And that is all we have for today, everybody. If staying up to date with the FASB is part of your job, consider taking our FASB update course that has all of the recently issued ASUs from the FASB. Additionally, if you're interested in taking CPE from Golasso Learning Solutions, we have included a very convenient QR code for you here. We have lots of different courses on accounting, auditing, government and nonprofit, A&A, if you need to get your Yellow Book CPE requirements, as well as leadership and professional development courses, even audit staff level training. So in addition to our live courses that we offer, we also have webinars and are on the LC Vista platform as well for our on-demand catalog. Once again, my name is Jacqueline Vino from Golasso Learning Solutions, and thank you very much for tuning in. Hopefully you have a wonderful rest of your day.